There's been noise that China's economy has not been doing as well recently, so I have this article up from Reuters to talk about it. So, China's economy worsens in July, industrial growth at 17-year low as trade war escalates. So the latest news isn't sounding good. China's economy stumbled more sharply than expected in July, with industrial output growth cooling to more than a 17-year low, as the intensifying U.S. trade war took a heavier toll on businesses and consumers. So that's all the way back in 2002. Well, usually when numbers are at a 17-year low, the news isn't good. Though, knowing what I do about China's growth rates from back then, which were like 10% year over year, the news from 2002 was probably just a temporary one-off blip, rather than any more substantial trouble. Well, this time, since there's more rumbling of bad news, it's more likely that this is an indicator of some sort of trend substantial trouble. Activity in China has continued to cool despite a flurry of growth steps over the past year, raising questions over whether more rapid and forceful stimulus may be needed. Of course, China's been doing stimulus continuously since the crisis in 2008, and now its economy has very high debt levels, and there's even less fiscal space in the government, and it has higher debt levels too. If the effectiveness of stimulus has been diminishing over time, I don't know what good more stimulus will do on top of that. It won't do as much good. Raising questions over whether more rapid and forceful stimulus may be needed, even if it risks racking up more debt. After a flicker of improvement in June, analysts said the latest data was evident that the demand faltered across the board last month, from industrial output and investment to retail sales. That followed weaker than expected bank lending and glooming factory surveys in recent days, along with the return of producer price deflation, reinforcing expectations of more policy support is needed. Yeah, those numbers just all together don't sound like things are going well at all. China's economy needs more stimulus because the headwinds are pretty strong, and today's data is much weaker than consensus, said Larry Hu, head of Greater China Economics at Marcari Group in Hong Kong. The economy is going to continue to slow down. At a certain point, policymakers will have to step up stimulus to support infrastructure and property. I think it could happen by the end of this year. Industrial output growth slowed markedly to 4.8% in July, from a year earlier. Data from the National Bureau of Statistics showed lower than most bearish forecasts in a Reuters poll, and the weakest since 2002. Analysts had forecast it would slow to 5.8%, from June 6.3%. Washington had sharply raised some tariffs in May. Infrastructure investment, which Beijing has been counting on to stabilize the economy, also dropped back, as did property investment. Infrastructure investment, which Beijing has been counting on to stabilize the economy, also dropped back, as did property investment, which has been a rare bright spot despite worries of potential housing bubbles. Crude steel output fell for a straight second month, while production of motor vehicles continued to fall by double digits. Okay, that's a really, really bad sign. High-tech manufacturing output rose by a slower 6.6%, and the country's power output edged up just 0.6%. The Industry Ministry said last month that China would need arduous efforts to achieve its 2019 growth target of 5.5%. China's economic growth cooled to a near 30-year low of 6.2% in the second quarter, and business confidence has remained shaky, weighing on investment. While officials have cautioned it would take more time for higher infrastructure spending to kick in, construction growth has been more subdued than expected. Fixed asset investment rose 5.7% in January-July from the same period last year, lagging expectations of a 5.8% gain and dipping from the previous reading. But readings by sector showed a more marked loss of momentum in critical areas at the start of the third quarter. Infrastructure investment rose 3.8% in the first 7 months from a year earlier, slowing from a 4.1% in the first half, despite massive local government bond issuance, mainly to fund road and rail projects and other civic works. Data from Japanese construction equipment maker Komatsu Limited showed activity remained weak, with operating hours for its machines in China falling for a fourth straight month. In a sign that housing market resilience may be waning, as Beijing cracks down on speculation, property investment slowed to its weakest this year. It rose 8.5% in July on year from June's 10%. Though home sales inch back to growth, new construction starts cooled. Retail sales are also pointing to growing consumer caution, most evident in slumping auto sales, but also in property-related spending on items such as home appliances and furniture. Retail sales rose 7.6% in July, well off consensus of 8.6%, and weaker than most pessimistic forecast. Sales had slumped 9.8% in June, which many analysts had predicted would be temporary. So China is dealing with a slew of very weak numbers. Of course, they're not an outright contraction, but the numbers are just getting weaker and weaker, or at least they're getting more and more weaker numbers than expected. Job security worries may have also been a factor. Nationwide survey-based unemployment edged up 5.3% from 5.1% in June, though market watchers believe it could be much higher. We maintain our view that growth has yet to bottom out and expect Beijing to maintain its easing policy stance, economist Nomura said. Nomura expects growth will slow to 6% in the third and fourth quarters, the bottom end of the government's target range. Authorities have already announced hundreds of billions of dollars in infrastructure spending and corporate tax cuts over the last year, and repeatedly cut banks' reserve requirements to free up more funds for lending and reduce borrowing cost. Even though there are fears of a bubble. But credit demand has been tepid, with companies in no mood to borrow or invest given the uncertain business outlook and banks' worry of raising bad loans. Sources told Rutgers recently that more aggressive action, such as interest rate cuts, are a last resort as it could fuel a rapid buildup in debt and financial risks. Highlighting those concerns, the Politburo, a top decision-making body of the Communist Party, took the unusual step last month of announcing it would not use the property market as a form of short-term stimulus. Recent months have been marked by a sudden escalation in a year-long U.S.-China trade war that has raised risk for both economies and sparked fears of global recession. A brief ceasefire was shattered earlier this month after U.S. President Donald Trump vowed to impose 10% tariffs on more Chinese goods from December 1st. China let its yuan currency slide to an 11-year low days later, prompting the U.S. Treasury to label Beijing currency manipulator. Some relief came on Tuesday, however, after Trump said he would delay duties on some Chinese imports, including cell phones and other consumer goods, in an apparent effort to blunt tariffs' impact on U.S. holiday sales. Still, U.S. tariffs will go into effect next month on about half of Washington's $300 billion target list of Chinese goods, and analysts say the chance of any durable trade deal after the recent escalation has sharply receded. So China has been dealing with a series of weak numbers, and the news out of China is looking weaker and weaker. Please share this video with anyone you think might be interested in it, like this video, comment, subscribe to my channel, hit the notification bell.